So here's one we did. We started this one. We gave all the money for this. This is a $2.75 million loan, 68% loan to value, which is actually on the high side for this type of product for us. And first mortgage, right near the new Eglinton LRT. This was, if you can see that one picture there, was one of those little bungalows, right? This was done on a 25 by 140 lot. That's about as small as you're going to get, and we can put one of these up. I think the ideal size is if you can find a 50 or 40-foot lot, and you can actually have more parking and stuff. So, and this is going to be a 4+1 with a garden suite in the back.
And Brian, maybe a question that comes to mind is, how are we able to generate over 10% returns for investors on a product that seems pretty safe, short-term, with a clearly defined exit strategy?
Well, this is a great question. So Dorr Capital, we can do structured finance. So we can actually layer with institutions. We can also do this one, which was a straight private deal, or we can do a blend of, or we can just do straight institutional deals. And I can even offer that in this product for developers. The feedback I got from developers is the speed of capital is way more important. So when I actually do this privately, what I do is I fund it up front. I have a full interest reserve, and then they have to come to me for draws to make sure that that what they have here is actually what we're funding. So we protect everything. And we use the same underwriting that I would have done on a condo or a large low-rise development. So we put the same rigor into these.
So Brian, I get asked the same questions by investors pretty much every single day, and I'd like you to share your expertise on a few of the most popular ones. First and foremost, why should I invest in a fund instead of picking out an individual deal to invest in?
Okay, so we do offer what's called syndicated mortgages, and I look at that group as a club. We get these high net worth types that they're permitted clients, right? That means they got 5 million or more.
5 million.
Yeah, yeah. So they love doing these syndicated deals. I also co-invest in a lot of these deals. But what I found over the years, once I started Real Alt, and I also invest in Real Alt, is that my return in Real Alt is pretty much the same. Except for if something goes wrong on one of those deals, I lose everything, right? Or I could lose everything, right? Where if something goes wrong in Real Alt, I don't lose. It's just so the standard deviation of loss is far lower in a fund. So we're much safer. So I go, other than the fact that I like picking deals and I like doing it and I want to see everything, and I get these guys, and I'm never, I have a $160 million book of that, so I'm sure I'm not getting rid of it. But I do believe that this is still a better product. This has got less risk built into it, and so for the retail investors, this is a much better way to get into our assets. Oh, we have an actual question. Let's go.
You said, if everything's going well, all is good.
Yes.
Can you give me an example of what could go wrong?
Oh, I can. And you're jumping my questions, but okay.
We're going to get to that, but yeah, let's go ahead.
Actually, why do I jump there?
Yeah,
because it's a real question. Okay, so first, and I'm going to answer two of our questions here. Okay, so the first thing we look at is our loan to value. Okay, so when we're looking at these portfolios, I have gone as high as 80%, let's say, in the good market. Today, our portfolio is just under 55%. It's actually 54%.
53.8.
53.8.
Yeah.
That wasn't by accident. I have been in this a long time, and I kind of go, I'd rather, I know things can happen. So if something does go wrong, I didn't really tell you what I did. My first job at CMHC, I was working out these projects. But what really that meant was I was in default management. So what I had to do was actually take back projects, manage projects, rebuild projects, enforce on the debt. Okay, so I have that training. I'm fully capable. I'm actually a certified property manager. I also got that at CMHC. So I have a lot of capabilities, if need be, to take over the assets, which we're quite prepared to do. But we also have so many things before that happens. There's so many techniques we can work on with borrowers to make sure we're good. So I'm not a predatory lender. We want to do what's fair. So if I think I've got a borrower that's honest, we'll figure something out. There's always a solution. But our number one defense was our loan to value. Number two defense is we have really good underwriting, and so we're comfortable with the values we've chosen. We mark to market our portfolio twice a year internally, and any new project that we bring in is appraised, and anytime we do a major refinance, it's appraised. So we do the best we can, but it's never perfect. But we do have the experience if something gets bumpy. Is there follow-up?
Yeah, I was thinking, like what, developer goes bankrupt?
So the typical thing that would happen, oh, I see, you want to know exactly. So the typical thing that happens when we have a bumpy project, it's always the same pattern. You get borrowers that get a little over their skis. So they'll commit to too many things. I think we talked about, I was talking to a gentleman at the back there. They'll commit to too many projects. Even if they have the money, they don't have the management capability to deal with it, right? So then that gets them. The other thing is, if we're doing construction, is cost overruns, okay? So we on staff have our own quantity surveyors. So what that means that's technical. What that means is that we actually evaluate how much it costs to finish this project, how much work is actually in place, and we do that math. And if it's off, we have a discussion with our borrowers. These two things are the number one thing that happens. So people stop managing it properly, it doesn't move as quickly as they can, and then we feel they're getting behind on their budget, and then we got to do something to correct it. Okay, so those are the number one and number two. The third is a little bit worse, is if they commit fraud or they sort of redirect funds somewhere else. We don't tolerate that. That means we're really going in and we're dealing with the whole thing and we're taking back that property. We don't run into too many of those. So.
The thing is, my son's an electrician in construction. There's one place, condos down, not too far from the lake shore. Beautiful condos, very expensive, and then the price of materials doubles.
Yeah.
Instead of actually real wood.
Yeah.
And the quality's not there. You know that roof's going to be leaking in 5 years.
We would monitor that, especially because these are smaller projects. Oh, I've done it for bigger ones, but we monitor that. We would know right away. We go out every month to every project we have ever funded in construction. I would boast that I'm one of the few that have the level of construction experience in terms of lending that you'll find in the Toronto market. There's a few of us, but there's not a lot.
But you get regularly inspect to make sure that actually is quality materials.
Yes, absolutely. Yeah, absolutely. To scope and to whatever, yes. I got another question. Okay, go ahead.
This is a tricky one.
Okay.
How to present this for teams, people, clients, which they normally invest in funds, hedge funds, stocks, and ETFs?
Whoa. I have some friends in those worlds because I do live in Toronto. So, and we talk about my investments versus theirs, and I learn about how they do things. One of my good friends actually does run a hedge fund, and he buys corporate debt, and I'm like, okay, what's that mean? And then he goes, well, what's real estate? So, I think the way you have to look at this is that there's two things. Because we're private debt, it's good because we don't get this mark to market with the market. Okay, we just it's not a daily thing where you see your portfolio go up and down. That's just not a part of what we do. The other is these aren't opportunities you can find. Like, I'm going out and going around the city of Toronto, creating a portfolio of investments of land in Toronto that yields 10% on properties that you could probably sell to anybody, and that's hard to do. So we have all the origination capabilities, and he recognized it's a lot of work to do what we do, right? He has half the staff of me and runs a portfolio of $1 billion. I'm like, okay, well, I can't do that. But so it's a lot easier for them to just buy off the market. What we're doing is like truly finding you unique assets and things that just aren't available. This is just not available. Unless you happen to know a guy and
Completely new, or it's just changing a little bit?
okay, I'm gonna say I've been around a long time, so nothing's completely new. Okay.
As for this, the real estate. I love this.
Okay, real estate's not, investing in real estate, syndicated mortgages, they've existed forever, okay? Real estate funds also existed for a long time. The trend really started from 2009 to today. I think it really started accelerating as an investment vehicle from about 2019, and then I think COVID hit and people just had interest in everything. So I think it got a lot more developed. The multiplex isn't a new concept, But for the city of Toronto and the way we're doing it, very new. And for Canada, like, just so you understand how it works in Canada, our zoning is by exception. So basically, you go to any city and you see what you see, that's the zoning. Okay? If you want to change it, you got to go to the city and get it changed. And you got to go to the province and get it changed. And then that process takes 18 to 2, 3, 5 years. I don't know. It can, in city with Toronto was taking up to 7 years.
There's a lot of regulations that involve it, right?
Yeah. If you're an investor, you can't make money until that product goes to market. And if it's taking you 7 years just to get it off the ground, think of all that money, that dead money. That's your example that you were giving, really, is that some of these equity deals that you can buy, that money's stuck there, and those IRRs are getting plummeted, right? So this, I haven't done an equity fund in this. I might decide to, but this is quick. We can be in and out of these mortgages, and that creates good liquidity for our fund, and they're very profitable. And if I have to take it over, I'm happy owning one. They produce income. We'll sell it, keep it, refinance it. It's a great thing. I think what the city has done here is completely innovative. And I'm saying this as a guy who used to work for the federal government and the provincial government. I've just never seen anything like it. So I'm all in.